All right, well, we are ready to get started. Thank you again for joining us this afternoon. And we have our awesome Joey Davidson here joining us today, getting ready to give you the new industry updates. Joey, can you hear us okay?
I can. Can you hear me?
We can. Thank you.
First time. Only one try today. And hopefully Brett will be ready to stand by when my phone goes out, so he can jump in and talk about whatever he wants to talk about. So it's been a couple weeks since we got together, and like I said the last time, before we departed, that I didn't want to waste your all's time and get on a call if we didn't have anything pertinent to discuss. But we have had a couple changes that I think it's important if you guys are updating your referral partners and your borrowers on what's going on in the industry. I think it's important that we update you guys with what we know. So we'll jump right into it. First part of this, we're going to talk about the market, and we're going to talk about rates a little bit. So the ongoing discussion in the industry is the spread between the Treasury and the mortgage rates. So for the longest time, we as originators have watched the 10-year Treasury and have had a pretty good idea throughout the day of what rates we're going to do based on the movement of the T-bill. So typically in normal times, that spreads anywhere between 170 and 180 basis points. And that's held true for the last 10 or so years. So it's been a reliable standard for us to watch. But over the past couple of months, you guys have seen that spread's increased to about anywhere from 280 to 320 basis points. And you can't predict which day it's going to be what spread. So for a while there, those of you who do not subscribe to a service that lets you know what rates are going to do, it was hard to predict or to understand why rates were doing what they were doing. So I wanted to just go through this really quickly for those of you who are interested in it. For the rest of you, I may lose you over the next 2 or 3 minutes, but hang with me and we'll get something that is more meaningful to you in just a minute. So the two things. One, so high demand in anything typically produces a lower rate. So keep that in mind for just a second. And it also produces a lower return, but it produces a lower rate. And the other is low rate represents low risk. So keep that in mind as we talk about this. So the Treasury bill has gone down, and we saw a couple of months ago that it dropped below 100. Now it's hovering somewhere in the 60s, but it got down to the lowest it's ever been. And the reason behind that is because the Treasury bill, one, it's the safest or one of the safest investments that anybody can invest in because the government backs the investment. And two, the reason people are flocking to the Treasury bill is because they're moving away from other investments that they deem to be risky. And one of those is mortgage-backed securities. Now, why do they move away from mortgage-backed securities? One, the things that we're all aware of. One, unemployment, obviously, uncertainty around surrounding the virus. So those things make mortgages more risky. But on top of that, when we're in a refinance boom, investors get a little nervous about investing in mortgage-backed securities because there's an expectation when you invest in mortgage-backed securities that there's going to be a time period that you're going to receive that investment. So whether that be whatever formula they have, whether it's going to be over a 5-year time period, a 3-year, a 7-year time period, there's an expectation that some time is going to expire where they continue to receive money on this investment. When you're in a refinance boom, that certainty goes out the window. So everybody's afraid that the investment they invest in is going to pay off really quickly and they're not going to get their return on what they invested in. So they move over to something that is secure, which is the Treasury bill. So right now, typically, just because of a refinance boom, that doesn't necessarily create that spread between the T-bill and mortgage rates. What's happening right now is lenders are still pricing in for the extra risk that they're seeing on the secondary market. So everybody believes over the coming months and as we recover that spread's going to narrow and we'll be able to track it again around the 180 basis points. But until some certainty comes back into the mortgage market, that's not going to happen. There's also a debate between, will it be because the Treasury rates come up, or will it be because mortgage rates come down, or whether it's going to be a mixture of those two. So stay tuned for that, but I just want to go through that really quickly. Does that make sense? Was that worth even going over? Okay. If you have questions about that, obviously chat them out, and I'll do my best to answer them. So let's go to investor appetite. I think the last thing we talked about was the GSEs coming out with their statement about forbearance and saying we will purchase loans in forbearance with the exception of cash out refinances. We're going to purchase them, but if they go into forbearance, we're going to charge you 500 basis points for a first-time home buyer, and we're going to charge you 700 basis points for everybody else, which kind of freaked everybody out. And investors also implemented the same guideline. So PennyMac, Wells, AmeriHome, all the major investors told people like Acopia, hey, you can sell us a loan, but if the loan goes into forbearance, we're going to charge you 500 basis points for a first-time home buyer and 700 for all other borrowers, in addition to a $1,000 administrative fee for every loan. So that sent everybody running for a while, not knowing what to do with these loans. Well, about 2 weeks ago, almost right after our last call, we started getting announcements, first from PennyMac, and then AmeriHome, and then Wells, and a few other players out there, saying that they are no longer going to charge us, Acopia, they're no longer going to charge us the $500 or the $700 or the $1,000 administrative fee. Well, it didn't make sense to me because there had been no news that came out in the industry to justify why they would pull that back. And so we finally gotten guidance on that. And what's happened is people have had a little bit of time to look backward and see how forbearance is playing out in the mortgage industry. And the initial thoughts about forbearance were that 1 in every 5 mortgage holder would file for forbearance under this new plan. Well, that didn't come true, for one. Something else that people didn't factor in, so right now I think the percentage of conventional borrowers who are filing for forbearance is somewhere around 7%, maybe up to 8% now. But let's say it's 7% just for the sake of this conversation. One thing they didn't factor in is that a very, very low part of that 7%, so a fraction of 1%, of the 7% that are going to file forbearance, only a fraction of those are going to be borrowers who have taken out a new mortgage. So the majority, the high majority of those are existing homeowners, mortgage owners who have not participated in a recent transaction. So that lowered the risk considerably for loans that investors are purchasing right now because not many of those people are going to file for forbearance. Something else that they found out is that of that 7% of conventional borrowers who file for forbearance, only 4% of those, let me say this backwards, of the 7%, 3% of those have filed for forbearance but continued to make their payments, which sounds very odd, but I think what's happened is they heard the news, don't have to pay anymore, it's a gift, you don't have to pay anymore. They signed up for it. They gained more information about forbearance, that this is going to be either tacked on to the end of the loan or you're going to pay it in a lump sum. So they're in forbearance, but they gained new information and they continue to make their payments. So all this information coming about caused major aggregators to take a look at what they were charging people like us and said, you know what, if the likelihood of forbearance from a conventional borrower is so low, then why are we imposing this penalty to scare off potential sellers of loans to us? So they've done some modeling. Our hedge firm participated in some of the modeling about forbearances. And rather than imposing a penalty on specific situations, they have done modeling to say if we add this amount to every single loan in our price, then we'll be covered for the isolated situations of forbearance. So that's what they've all done. They've modeled forbearance. They've put it in their price. And this is another reason why the spread between the Treasury and the mortgage rates is still extended because of them modeling for risk in this situation. So, but that was a huge relief on independent mortgage bankers, especially the ones who do not have the ability to service, that removes some fear from the process. Christy sent out an email the other day. I know another looming question in the industry was, if a borrower files for forbearance, does that prohibit them from getting another conventional loan? And for a while there, the guidance from Fannie was that it's going to follow the normal guidelines and they would not be eligible for conventional financing for at least 12 months after coming out of forbearance. I know Christy sent out an email to everybody the other day, and I'm 100% confident that 100% of our people read 100% of the emails that she sends out. But I did ask her if she didn't mind to just hit the highlights of what this new ruling means. It's a great change for our industry. It's some clarity that where we didn't have clarity. But Brandy, if you don't mind unmuting Christy, or Christy, you may have to hit *6. But if you don't mind educating us one more time on the new ruling from the FHFA.
Yes. Hey guys. First of all, can you hear me? Okay. Yeah, as Joey said, you know, when the guidance first came out, I guess maybe a couple weeks ago, we were instructed by the agencies that we would have to consider those missed payments as late payments. And we are very excited that Fannie Mae and Freddie Mac have come out with this new guidance under the FHFA, stating that we do not have to consider those missed payments as a historical delinquency in our assessment of the previous pay history when we look at it from a standpoint of excessive mortgage delinquencies. But they have given us guidance on how that impacts a borrower's ability to qualify for a new transaction. And they've lumped it together as purchase and refinance. They haven't differentiated between the two, but they've basically broken it into two categories. The first category applies to borrowers in a similar situation to what Joey mentioned earlier, where they took the forbearance, maybe didn't know quite what they were getting themselves into, so they signed up, but then they kept making their payments. Or even maybe if they missed a payment, they have since reinstated and caught back up, and they are now what we consider to be current. For those borrowers, once they are current, they are eligible to purchase or refinance a new property. When we say current, just make sure everybody understands that that's not the same as what the CARES Act refers to as being current. Current means they've actually made the payments. All payments that were due have been made prior to the last day of the previous month. So they are only due for the current month's payment or the next month's payment. In that case, they're eligible. If the second category is if maybe they have entered into some kind of loss mitigation solution, and that can look like a couple of different things. That can look like a repayment plan where they are maybe increase their original monthly payment slightly to kind of catch up those missed payments. It can look like deferment, where they deferred those payments to the end of the term, or it can look like a true loan modification. So under those three different categories, if they have entered into any kind of loss mitigation solution on a mortgage, they will be eligible again once they have made at least 3 payments in accordance with that agreement. So if they're doing a repayment, they had to have made three payments under the new repayment agreement. You can't prepay. It's just like anything else. You have to have 3 consecutive months payments under that new plan. Under a loss mitigation, they have to have completed the 3-month trial period. There are a couple of things that I want to make sure everybody understands on that we point out. This is the guidance that's specifically coming to us from Fannie Mae and Freddie Mac under the direction of the FHFA. So this applies to conventional financing. It also applies to all mortgages, not just your subject mortgage. So if you're doing a refinance It doesn't just apply to the mortgage associated to the subject property. It applies to the mortgage they have on their investment property or their second home. Any mortgage where the borrower is responsible, this guidance would apply. Also, you will have to obtain additional documentation to show that pay history when they've entered into a loss mitigation solution. So you're going to need to be able to show that they've made those 3 consecutive payments, or you're going to need to be able to show if they're current that pay history. So that may require us getting additional documentation such as an actual transaction history from the mortgager, or it may mean getting a copy of the borrower statements directly from them if that would be faster, but we are going to have to document those payments being made. I don't know just yet how much we'll be able to capture through a credit supplement, but we're certainly open to looking at that also, just depending on how much information we can capture there. Another thing I want to point out is if the borrower has chosen to reinstate, let's say they missed payments, but they reinstated, made those payments up, if that reinstatement occurred after the date of your application, you will have to source where they got those funds to do so. So just like paying down a large balance on credit, you're going to have to show the source of where those funds came from to make sure there aren't additional liabilities or borrowed funds. You cannot use proceeds from a refinance to reinstate a mortgage. So if it's reinstated, it has to be reinstated and caught up prior to your new transaction. But what you can do is if, for example, you're doing a refinance and the borrower's entered into a loss mitigation solution, you can use the new loan amount to pay off the entire balance of what's due. You just can't use the refinance to actually catch them up and reinstate the mortgage. Again, they're not going to look at those missed payments as historical delinquencies, so we won't have to consider them in the pay history necessarily as late pays, but we will have to show that either it's current now or they've met the 3 payment obligation under the new plan. All right, and then one other thing I just wanted to mention really quickly that is off topic a little bit, but this question has come up several times over the last few days, so I thought it was worthy of mentioning on our call. We've received several questions about how student loan deferment or forbearance is being handled. Obviously, as you all know, outside of the borrower's control, student loans have been placed into deferment whether or not they were in a repayment plan or not. Obviously, with FHA loans, we are not allowed to use an income-based repayment in qualifying anyway. You have to use the greater of 1% of the payment on credit. But for your conventional loans, I did confirm with Fannie Mae this morning that even if the payment has been placed into deferment because of the CARES Act, you can obtain documentation to show what the income-based repayment plan amount was prior to it being placed in deferment and still use that in qualifying, because we know at the end of that 6-month deferment period, it's going to go right back to what it was before. So as long as you can obtain that documentation from the creditor, and your borrower should have received some kind of letter when it was put into that repayment plan, and we can see what that payment is once it's supposed to come out of deferment, then we can use that for qualifying instead of having to use 1%. All right.
Good deal. Thank you, Christy.
You're welcome.
If you'll have questions for Christy, obviously shoot those to the chat. If we don't get to them, we'll send them out a little bit later. A couple of other things with investor appetite. So jumbo loans still are not back. And we're hoping they'll come back. And we know they'll come back. We're hoping they come back soon. Conforming high balance is back, but it's not priced very good. But they are in the system. You can price them out. And then conventional cash out. So I asked Christy to do some dirty work for me and send out an email the other day that we had to do LP on cash out. I didn't realize that it was going to affect as many loans as it did. But the reason behind that, so we're having an issue in our system with servicing loans with Freddie, and we're trying to get it worked out. But most of these conventional cash outs right now we're having to service those just to eliminate any risk from an aggregator coming back and deeming that loan ineligible for delivery. And so most of them are run through DU, not that big of an issue. But hopefully in the near future, we can pull back on that guidance and allow you to do LP on cash out. But for now, please continue to run those on DU. Rest of the year projections and into 2021. So I'm sure you guys are still keeping up with the webinars, the videos, everything that's going on out there. But everything seems to be positive, optimistic through 2021. And typically, like any time that the economy is not doing well, mortgage rates do well, and there's expected to be quite a long recovery for us to get back to normal. So that bodes well for our business, not so much for the economy, but let's hope that both do well in the coming months. Purchase applications, we've seen a spike across the industry. We've seen a spike at Acopia. Brett sent out a good email the other day. Brett, I can't remember the percentage, but we were up considerably month to date over last month, which is a sign of the season. But it looks like the numbers are definitely outpacing the projections of a slower purchase season due to the coronavirus. So we're all convinced that everybody's house is much smaller now than it used to be, and that everybody's looking for a change of scenery. We just hope that there's going to be inventory out there that builders can keep pace. But we do see the appetite is definitely there for the purchase season, and it's already showing up in our numbers. So along with that, refinance activity should continue. So don't assume that all of your previous borrowers have refinanced. Keep an eye on that. There may even be an opportunity to refinance some of the folks we've refinanced if mortgage rates behave properly in the later part of the year. So don't push all the refinances to the side just yet. Technology. So we're exploring a couple things in the company right now. No guarantees on either of them, but we are looking at what we deem to be a better point of sale, so our application online, along with a better process for our disclosures for our borrowers, for our mobile app. It's quite expensive, but we're looking at it right now, and if we feel like we can justify it, we may pull the trigger on that. Outside of that, the other technology is for e-closings. Kelly's been doing a lot of work on that, and we're really looking toward the third quarter to be involved in hybrid closings. If you're not familiar with hybrid closings, it is an e-closing minus the documents that need to be notarized and the security instrument, right of rescission, a couple others. So about 5 documents that would have to be wet signed at the closing table, the remainder being e-signed in the comfort of the borrower's home prior to closing. And a couple of reasons we're going to that. One, that's just where the world's going. That's where the industry's going. 2, it's a major selling point with your referral partners when they show up at a closing and it takes 15 minutes versus an hour. And 3, in order to get to a full e-closing, this is the baby steps. These are the first steps to get there. And hybrid closings are a big thing right now in the industry. Not everybody's participating in them just yet, so it'll be a selling point for Acopia if we can get on board with it in the near future. But stay tuned for that also. And lastly, Memorial Day coming up this weekend. I hope everybody can enjoy your Memorial Day weekend. I know it's a holiday where we remember loved ones that we've lost, and I know we have a lot of people in the company who've experienced that this past year and in years past. So our prayers go out to all of you guys. But be safe this weekend. Enjoy your time. Hopefully you can rest just a little bit so we can get back at it on Tuesday. Anybody have any questions before we let you guys get back to it? Congratulations ahead of time for a great May. We thought that the fun was going to go back to normal times again, but looks like you guys are has slammed out another great month, so congratulations to you. All right, if there's no questions, if nobody else has anything, Stephen is about to fall asleep, so I'll let you guys get back to it. Great to see all you guys, and we'll talk again soon. See you.